Hi, everyone. My name is Sanat. I work at the Spartan Group as a crypto investor. For those unfamiliar with us, we're a venture firm based out of Asia. Today, I'm going to be talking about token launches in general. I just want to preface this by saying it's a little different than what was in the abstract because I kind of planned this talk 6 months ago, and crypto moves really fast, so some of that stuff is out of date. The general goal of this talk is just to kind of help protocol teams and founders refine how they think about token launches in general. A question that's become especially relevant to founders as we're going through tougher market conditions, and a lot of them are trying to figure out what's the best way to launch a token right now. So I'm going to start with some key takeaways, and then I'll talk about some more specific examples to sort of illustrate the trade-offs that founders are facing these days when doing token launches. And so the key takeaway, I think the most important takeaway that I've learned from doing research on this stuff and chatting with a lot of founders is that there does not exist a perfect token launch mechanism. And we have conversations with founders often, and they sort of are just like, okay, well, how should we launch a token? Should we do this? Should we do that? And in fact, different mechanisms, different venues, different avenues for token launches achieve very different goals. And so it's super, super important that founders spend a lot of time figuring out what works for their protocol. And that's kind of the key step here. Like, you need to think about a token launch and figure out what's most important to you. And I'll chat a little bit about some of the goals that founders can hope to achieve while doing this. A couple of the other takeaways. The second one is just that good token launches, good token mechanics, they don't fix bad products. But bad token launches and bad token mechanisms can certainly make good products uninvestable, and anyone that's been investing in crypto for some time will probably be able to attest to this. The third takeaway, and I'll illustrate this with examples as well, is that the liquid token market, as obvious as it sounds, is a market, and so you have a lot less control about what happens in a liquid token market, and you can't really defeat it, and so it's important to try and sort of use this to your advantage and not try and control what happens once your token is in the liquid market. And so I'll just walk through very briefly about some of the goals that founders may have when they're doing a token launch. The first and possibly most obvious one is raising capital, and that's quite self-explanatory. I don't think we need to chat a lot more about that. The second is liquidity. And so liquidity essentially means that your token is now tradable. The market is able to find a correct price for it. Early investors, early team members may be able to have liquidity. And there's sort of now a market that's determining what your token is worth. I just want to emphasize that if these don't sound like things that you want, then you shouldn't be in a huge hurry to launch a token. The third is just a tool to incentivize usage. So this has been kind of a key thing that has worked or not worked for a lot of DeFi protocols, but this is something that almost all crypto protocols do. And we've had other talks at ECC that go super deep into liquidity mining and what's the right way to do it. I think more than anything else, all I'll say here is that a lot of the kind of research around liquidity mining has shown that it doesn't actually have all the effects that you expect it to in most cases. Just generally, I find this sense in founders that they're a little too eager to give away tokens or sort of frivolously give away tokens. And so it's really worth emphasizing, particularly in a bear market, that tokens are a valuable financial resource, and you should think very carefully before giving them away. The next one is sort of decentralizing token ownership, and I put this in quotes because this is kind of a more nuanced topic. There's kind of this idea that we decentralize token ownership just because this is crypto and we have a community ethos. But underlying this is there's a lot of legal ramifications around securities, and a lot of founders are actually in a hurry to kind of do this because there's a sense that the SEC will come after you if your token ownership isn't decentralized enough, that utility revenue, there's a lot of kind of different aspects to this. I'm not a lawyer, so I won't talk too much about this, but I think one thing that founders in this space do is just sort of copy what other teams have done very blindly, assuming that there's some sort of legal precedent been set. And very often that's not the case. So if you're giving away a lot of tokens in the hope of kind of avoiding securities regulation, you should chat with a lawyer and make sure that's actually how it works. The last two are sort of rewarding community members, and this is obviously a pretty key principle for a lot of crypto projects. I think the day I got my first Uniswap airdrop was a pretty special day in kind of helping me get excited about crypto. But again, and I encourage you guys to read, there's a lot of interesting research that's been happening about this. A lot of airdrops get sold very quickly now, and we have ruthless airdrop farmers. And most founders that we've actually worked with that have recently done it haven't found that it's benefited them in any meaningful way. The last is just to enhance product functionality, and this is kind of more specific, but if you think of sort of tokens like Curve and Convex, where owning the token actually lets you earn higher liquidity rewards and plays a big role in how the protocol accumulates liquidity, or games like Axie, where Axie and SLP are kind of key to how the game functions, and so maybe you're a team that needs your token for your protocol to work. And I won't get into too much detail of this, but this is, of course, another goal for a token launch. And so very broadly, I think the key principle here is that project teams need to figure out, what are they hoping to achieve when they launch a token, and pick mechanisms that work accordingly. I won't spend too much time talking about sort of specific auction mechanisms, but since I'm going to go through some examples, just want to walk through some of the more common ones. One of the most common ones that I think we're all familiar with is just a fixed price sale. Super simple idea, you sell tokens at a certain price. CoinList is probably the venue that people are most familiar with to do this, but lots of decentralized venues have been able to do this as well. A second mechanic is an uncapped batch auction, where you sell sort of a fixed number of tokens and let people put in as much money as they want. This is usually a good strategy if you have some degree of hype around your token and you're looking to maximize your capital raise. A third mechanism are sort of Dutch auctions and balancer LBPs. And while these are actually a little different in practice, the idea is very broadly that you are trying to run a healthy price discovery process during your token launch process, during your sort of token auction. The other two, airdrops, I think we're all familiar with. I also want to talk very briefly about lock drops. They're a mechanism that was pioneered by sort of Delphi and a few other researchers. It's just an interesting idea that kind of flips the airdrop idea in the way it runs sort of chronologically, where with an airdrop, you've usually used a protocol, and they'll reward you for using it once they launch a token. And with a lock drop, you sort of agree to either provide liquidity or use the protocol in some manner, let's say during its first year. And you've already agreed to do that, and in exchange, you will receive tokens. And also just want to mention that there's multiple venues to do token launches. Sushi Miso was a very popular one last year. Protocols run their own auctions very often. CoinList, centralized exchanges as well. So now I'm going to talk about the kind of first case study that I spent a lot of time looking at. And this is YGG and Merit Circle. And so for those of you unfamiliar, both YGG and Merit Circle are some of the kind of strongest teams in the space building out gaming guilds. And they both launched tokens in sort of the second half or middle of last year. And this was sort of during a period of very high retail appetite for token launches, particularly those related to gaming. We were basically in the middle of gaming mania. And I think the difference in outcomes between these two token launches sort of illustrates the importance of thinking through parameters and mechanisms for token launches very carefully. And so I'll chat first about the YGG one. And so YGG did a Dutch auction. It's a very simple idea. You set an initial price. Anyone can buy at that price. And during the period of the auction, the sort of price is gradually declining. And so the sort of price discovery, and if you think the price is right, you can buy at any point. However, YGG sort of set the initial price, the highest possible price you could buy at, quite low. It sort of corresponded to a 250 million valuation, which was low given market conditions at that time. And it was kind of a crazy Dutch auction where it was completed in 2 Ethereum blocks, and the entire supply was purchased by 32 accounts. The winning transactions paid 1 plus ETH and gas fees. So this is not a great auction. This is just kind of people deciding the price is super low, and sophisticated market actors who are able to kind of run bots, buying up the entire supply. I think about 40% of the supply was bought by one particular account. And within a week from this token launch, the price of the token had 4x'd. Within a month, I think it had actually 20x'd from the sale price. So again, I think the clear takeaway was that the price was set too low. This just kind of shows, if you see this chart, there's kind of the price was supposed to gradually fall from half a dollar to 20 cents. It was all bought up in the first block. We didn't even get a chance to move along this graph at all. And yeah, 32 participants. And so if we kind of think of the end result of this Dutch auction, community and retail participants were certainly excluded from this private token sale, which was one of the stated goals of YGG. And then the other really big thing here is that YGG left a lot of money on the table. So the token price increases very significantly from the token sale. This massive return is sort of earned by 32 very sophisticated market participants that sort of buy the entire supply using bots and high gas prices. And if you dig into the data, most of them sold it within the next month. And I think people often refer to some token sales as cash grabs, but if the money is going to be made by someone, it's much better that that money is used to further the interests of the protocol. So YGG raised 12.5 million in this token sale. Bots that bought very quickly on this token sale probably themselves made many multiples of what YGG made from this token sale. And that money, again, I want to emphasize this, does not further the interests of the YGG protocol in any way. And so this is not a win for YGG token holders at all. And so Gabby, and I think Gabby is one of the strongest founders in this space, had actually tweeted after this saying that we could have either done a batch auction with no cap, and everyone could have probably bought, but the ending price might have been above $1 billion. And Gabby, on an interview had said, I think 1 billion was just like not the right valuation. It felt too high. Or we do a Dutch auction where we cap the valuation, but participation could be limited. And I think this is one of the kind of misunderstandings of founders where valuation is too high, valuation is too low. It's just not in your control. Once you've launched a token and it's live, the market will decide a price for your token. And so, Gabby here saying that the ending price would have been above 1 billion, and we think that's too high. The token price was above 1 billion in like 48 hours after the token launch. And that's bound to happen because it is a liquid token market, and you don't control what happens to prices in a liquid token market. And so I think founders really need to remember this, that you can't defeat the market. It's much better to just embrace it and try and make sure you reap as much of those gains in a way that furthers the interests of token holders and your own protocol. And so to contrast this a little bit, I'll talk about Merit Circle, which was another gaming guild that did a liquidity bootstrapping pool for their token. Balancer LBPs, I don't want to spend too much time on the mechanics. You kind of set up a liquidity pool with a starting ratio of some number of tokens and stable ETH. I don't know if you guys are familiar with Balancer, but it's a Uniswap model, except you can kind of set the ratios not 50-50. And the way the ratios change over time, and basically what's happening is that anyone is able to buy at the original price, and if nobody buys, the price gradually declines. But market participants are able to buy, and the price will either increase or decrease depending on kind of how many people are interested. I think the key takeaway is that Balancer LBPs sort of determine a healthy price discovery process during the auction period, similar to Dutch auctions when the price is set right and not too low when you get started. And so, the price of the Merit Circle LBP also started at $1, but ended at $3.2. And I think, retail appetite to buy this token was very similar to what it was for the YGG token sale. And so there were 4,000 individual accounts that actually purchased Merit Circle during the process. A lot of these accounts were buying amounts of a few hundred, a few $1,000s, which is very different from sort of 32 accounts buying 12 million in the YGG case. And I think the last point that I really want to emphasize is that this allowed the Merit Circle team to raise a large amount of capital. It was 108 million that they managed to raise. And 108 million is a really valuable war chest if you're thinking in a 5, 6, 10-year horizon and want to build through a bear market. And again, the thing I want to emphasize is that this money was probably on the table for YGG, and instead the same money went to sophisticated market participants that ran bots. It's not even like, it's not that retail participants were able to earn a very high return. It's very specifically that a set of sophisticated market participants took a lot of the money that YGG left on the table. And yeah, so again, the healthy price discovery process here. The Merit Circle, the price would have fallen as in a Dutch auction, but the retail appetite was high, and so the price actually rose throughout the entire period of the auction. One thing I want to note here, as we think about Merit Circle and YGG and the kind of contrasting token sales they did, is that if your goal is very specifically to sort of reward reward retail participants, allow them to get in at a quote-unquote fair price, and allow them to share in the upside of the protocol, then you can't sort of run an open-ended Dutch auction where anybody, including bots, can participate. And so there's a team called Halo DAO that I think did a pretty interesting token sale as well. For those unfamiliar, there's sort of a stablecoin protocol that's more focused on stablecoins for East Asian currencies. And so Halo DAO did a token sale at a fixed price via Miso as well, where essentially there was a limit that you could only buy $650 per address. And if you just ran this on Ethereum, there's no actual Sybil resistance because I can just make 100 addresses. And so they sort of actually solved this by announcing the token sale in advance. And then if you wanted to participate, you had to go through a KYC process that was run through their Discord, where you sort of shared your identity, linked it to your address. And that kind of allowed them to make sure that a large number of individual users were able to purchase at max $600 of the token, and then share in the upside of the token when the price increased. And most teams do this via CoinList. CoinList is kind of centralized infra that just lets you KYC people and ensure that they can buy a limited number of tokens. But yeah, if your goal is to kind of decentralize token ownership and allow retail participants to benefit and be a part of your ecosystem, then you have to find a way of making sure that the tokens can actually fall in their hands at fair prices that you intend to sell it to them, as opposed to kind of a YGG-like Dutch auction where 32 people buy all of it. So that's kind of the first example I wanted to walk through. A second interesting example is that founders are often, I think particularly in crypto, a lot of founders are thinking through, are familiar with auction mechanics, thinking a lot about ways to optimize sort of the economic launches they do. But very broadly, I think we figured out a lot of things about auction mechanics, and it's not worth ignoring them. And so I'll chat a little bit about uncapped batch auctions, mango markets, and how they kind of tried to change the traditional way uncapped batch auctions run and how it sort of went wrong. And so in an uncapped batch auction, let's say you have a period of 48 hours where the auction is running. Anyone can contribute money. And at the end of the period, you just see how much money everyone's contributed. You figure out how many tokens, which is a fixed amount preset that you're giving out for that amount of money, and therefore the price just becomes the dollar you've raised and the fixed number of tokens. One issue with this mechanism is that if I'm the first person to put money into this auction, I have absolutely no idea what valuation I'm paying or what the price is going to be. If a lot of people put in money after me, the valuation could get super high, and I basically have no mechanism to exit. And so the end result is that there's really no incentive to be the first person into an uncapped batch auction unless you're just insanely bullish. It's much better to kind of wait till the end and see what the price actually, what it looks like the price is going to be, and then put in sums. And this is kind of an inefficient mechanism. There's no reward to committing early because the price increased substantially. And so Mango actually had what I thought was initially a pretty interesting idea to sort of solve this with a complex auction design. And so the way they did it was they had a sale period and a grace period. And so, for the first 24 hours, you can put in money. And even during that time, actually, you can withdraw money as well. So you put in money, other individuals are putting in money as well. Based on how much money is raised, the price is sort of fluctuating. You can calculate what the valuation is going to be. And if the valuation rises to a point where it's too high for you, you can withdraw your money. And then there's a grace period where you can only withdraw money. And so during the grace period, you're all trying to figure out, OK, this is what the price will be. And then you kind of take a decision, this price is too high for me, and you can pull your money out. And while it sounds nice, unfortunately, a lot of sophisticated market participants figured out a good way to benefit from this. And so this chart, which was made by someone on Twitter that I don't know, but I thought was really well done, kind of showed how much USDC Mango markets gathered during their sale. And so there's a sale period and a grace period. And at the beginning, by the end of the sale period, it starts with 200 million. And then by the end of the sale period, they've actually got $500 million in this uncapped batch auction. And $500 million is a crazy sum of money. At the time, I believe it was 1/3 of the USDC on Solana had been put into this Mango Markets token sale. And if you're a sort of retail investor that puts money in and you see, OK, there's 500 million, and that corresponded to some absolutely insane $100 billion valuation, you're probably pretty incentivized to pull your money out. And so through the grace period, we saw that a lot of the smaller accounts that had put money in withdrew it. And then a set of very sophisticated whales very, very close to the end of the grace period, pulled out 90% of what they had put in. So, it looked like Mango Markets was maybe going to raise 500 million, maybe people would pull out, but sophisticated market participants actually pulled out 90% of what they had put in just at the end to reduce the price very substantially after kicking out sort of smaller participants. And they ended up raising like 50 to 70 million. But the sophisticated market participants did a pretty good job of making people think that the price was super high during this sale period and grace period and kind of kicked a lot of others out. And again, this is only a thing you can achieve if you have $400 million of cash to kind of play with. And so there's only that many entities that can kind of play these games. And so it's kind of unfair if, again, your goal is decentralizing token ownership. Yeah, so this is kind of interesting, right? So if we looked at the top accounts that had deposited, this one account deposited 71 million during the sale period. And 5 minutes before the sale ended, they withdrew like 65 million. And so they ended up only putting 4 million in. The price they got was a lot lower, but they ensured that anybody else in there was very worried that they were going to end up paying a super, super high price for this. And so, again, I think it's really important there's layers of thinking to auctions, and economists and other people have thought very deeply about this. And so you should probably be careful when kind of trying to design something new and making sure that it's not sort of subject to attacks like this. The last thing I want to touch on today is more generally thinking about whether you should launch a token in a bull or bear market. We've been having conversations with founders in the last 2-3 weeks. Opinions differ very widely on this. There's a lot of people who say you should launch a token as soon as you can. Bear markets are great times to launch tokens. I think it's much more nuanced than that. And there's obviously the opposite end of people who say, like, you should never launch a token during a bear market because you won't be able to build a community. I think, again, as I said in the start of this talk, there's a very large trade-off space with token launches. And it's very, very important that you figure out what you need. And so advantages of launching in a bull market. Capital is plentiful. I think I walked through a few examples where you've already seen teams have raised, depending on people have raised $50 million, people have raised $100 million. Coinless sales go super well during bull markets. Appetite for public token launches is extremely high during bull markets and extremely low during bear markets. And I'll illustrate this a little bit towards the end as well. But I think this is a point that's really important to emphasize. I think actually private investors, and I'm a private investor, but private investors, of course, are also swayed by markets and prices, and private markets move very fast as well. But it's hard to overstate how high variance the appetite for sort of token launches among retail and community investors is based on whether it's a bull or bear market. In a bull market, like teams building subpar quality products are often able to raise crazy sums of money with some degree of marketing. There's kind of hype. There's an L1 ecosystem that everyone's excited about. They'll fund anything happening on that L1 ecosystem. And it's entirely the opposite during bear markets. And funds are actually a little better. Like private capital is usually a little better place to maybe overpay a little less during a bull market, but they're also willing to make more bets during a bear market that retail isn't. And when you're launching in a bull market, it's easier to build interest and a strong community. The disadvantages of launching in a bull market, and again, this is one of those things that it's sad because it hurts many founders, but it's out of their control. Tokens can reach extreme valuations, and you should definitely spend time thinking about how liquid your token is so that you get a chance to figure out, there's lots of people that are talking about low float, supply, making sure that there aren't dynamics that lead to very sort of unhealthy price bumps. But one way or another, if the token is very high priced in the public market, and you as a founder know it's overvalued, it can actually create very challenging dynamics. And I think the place where it's hurt a lot of founders in particular, and we're hearing this from many teams that we've invested in and founders in the space more generally, is that hiring and retaining team members is very challenging because we're all in crypto for the upside. And so when you hire team members and your token valuations are very elevated, and if token prices decline to what may be more reasonable valuations in bear markets, it can kind of suck morale and break the sort of financial incentive structure that you've put in place for your employees. And so these are all kind of things you have to be super aware of when you're launching your token publicly, and make sure that you've kind of thought through these as well. The last thing I just want to chat about is And if you're thinking about, I know we're at ECC, people are really excited about DeFi applications. I'm in this space because I love DeFi. But as pragmatic founders, I think it's worth thinking about when you're thinking about centralized venues versus decentralized venues for token launches. And again, this is more and more relevant in tougher market conditions. FTX, Binance, Bybit, CoinList, and actually many, many others. It just remains true that in crypto, the number of users and reach that these platforms have is still far, far superior to what DeFi platforms have. So, I'm in this space because I want DeFi to break all of these platforms. But if you're a founder today, it's really important to realize that CoinList sales and CoinList and FTX still have way more users than DeFi does. Like, I think there's stats vary between 2 and 4 million addresses that have ever meaningfully interacted with DeFi protocols. And that's a very small subset of the kind of user base that platforms like Binance and FTX have. And so, to illustrate this, like token sales in DeFi usually have significantly fewer participants. Even the really exciting ones, there's usually maybe 4,000, 5,000 addresses that are participating. Again, this can be mitigated if you have the right kind of large capital, if you have capital allocators with large amounts of money that are willing to participate in your token sales. Perpetual Protocol, which is another really strong team building great products. I think there were less than 1,500 participants in their token sale. Airdrops usually go a little better. I think the best airdrops have had, the Optimism airdrop had 150 addresses claim. Again, that's very likely not 150K people as much as they try to solve for Sybil resistance. And then Hop, which is another really cool bridging protocol, had about 22,000 people claim their airdrop. But again, these are rookie numbers compared to centralized platforms. So just to kind of illustrate, like CoinList regularly attracts like anywhere from 250,000 to 500,000 users on token sales. And so these are just two, Axelar, Mina, both kind of very interesting technological platforms being built. Mina had 250,000 users. I think Axelar also had, I believe, more than 300,000 users at peak participating in these token sales. So it's just something worth keeping in mind as much as we all love DeFi. There are trade-offs in this space. The last thing I want to illustrate is just a point I had made earlier, which is that retail appetite for token launches and it's fund appetite as well, of course, like within DeFi, we have funds playing as well. But raising funding in bull markets from public markets is a lot easier. These are kind of three of the better Solana projects. Mango raised 70 million. Solend had managed to raise 26 million. UXD, a really interesting stablecoin protocol, raised about 57 million. And these are sort of balancer LBPs that have happened recently. I obviously don't have the team names here, but they're all three teams that, some of them we've chatted to. They're all building they're all building real products and trying very hard to sort of make something that's useful. And unfortunately, they've had terrible market reception. And so if raising capital is one of your goals, unfortunately or fortunately, it's a pretty tough time to be trying to raise capital in a decentralized way. Yeah, that's it for me. Thanks.